The Vanguard Dividend Appreciation ETF, the largest dividend ETF, it focuses on companies with a consistent history of dividend growth, which can provide reliable income for investors. The index is composed of U.S. stocks that have a history of increasing their dividends consistently over time. It includes companies that have increased their dividends for at least 10 consecutive years. These companies are typically characterized by their financial stability, strong cash flows, and commitment to returning value to shareholders through regular dividend increases. Vanguard High Dividend Yield ETF, the largest high dividend ETF. It focuses on U.S. companies with above-average dividend yields. The fund tracks the performance of the FTSE High Dividend Yield Index. VYM invests in companies that have higher dividend yields than the overall market, but these companies may not have a history of consistent dividend growth. VIG's $65 billion assets under management is larger than VYM's $57.1 billion. However, both are large enough to ensure significant liquidity and economies of scale that many ETF investors are looking for. VIG and VYM have the same expense ratio of just $0.6 or $6 for every $10,000 that's invested. VYM's yield of 3.4% beats that of VIG's yield of 1.97%. VIG beats VYM in both the short term and long run. Who should invest? VIG is a suitable investment for investors who are looking for exposure to U.S. equities with a focus on dividend growth. VYM can be attractive to investors who are looking for income over the short term, as it focuses on companies with higher dividend yields. VIG is focused on dividend growth and has a more diversified sector exposure. VYM is focused on high dividend yields and has a higher concentration in certain sectors. The ultimate choice of investment between these two Vanguard ETFs depends on an investor's goals, risk tolerance, and portfolio strategy.